Good afternoon, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for August 4th, 2012. We have a market that's in bullish normal conditions. On an annual basis using weekly RSI 14, we're at 60 out of 100. The 10-day NDX, we're at 96 out of 100, so the market is overbought. Percent stretch above the 200-day moving average at 5.99% is coded white bullish, and the slope of the 50-day moving average also white bullish. ADX is weak at 14.3, although the bulls are now in charge, and potential for upside gains is indicated. Blended monthly rebalancing, the current holdings are as shown. Next reevaluation on or about 1 September. In ETF2, the theoretical exposure is at 90% and the model portfolio is at 90%. Quick look at the blended monthly rebalancing portfolios. In the 13 ETF, Treasuries, Real Estate, and the Spiders, followed by the rest of the U.S. with the Qs and the Diamonds. Asia less Japan and Australia have stuck up higher into this and have now started to bypass the weakening small cap and mid cap sectors. Only Japan is on cash. In the 26 ETF portfolio, Treasuries, Agriculture, Emerging Market Bonds, followed by the rest of the U.S. stack. It's still the internationals in general that are the weakest, with Brazil, the BRICS, China, Latin America are lagging. Market health check. Blue vertical lines are 10, 20, and 30 days worth of look back. Horizontal purple lines are the resistance levels. Horizontal red lines are the support levels. Shaded red area is the 200-day moving average and below. You can see where it bounced in June and held support. The blue river is one Bollinger Band with a 30-period look back, plus or minus 1 standard deviation. Thin green, is a 10-period moving average. You can see that's pointing up. The 50-day moving average is thin red. That has rolled over, starting to hook back up. Black line in the center is the 30-period regression line. The outer black lines are the channel formed by the maximum excursion from the regression line during the look-back period. And you see that's held 3 times and made a nice upward rising channel. And 3 times it's tested the upper limit and reversed each time. This is healthy that it found reversal at the mean and is now going back up to test. The price closing above 139 was very important. It's above the second to last resistance line at 138. The next one's at 142. If it takes that out, that's a new high above the March high at 142, and that will be clear sailing above. Until such time, though, as that happens, we are in a trading range market between 142 and the rising 200-day moving average. So you can see we've got a rising wedge here. The blue lines simply are a Andrews pitchfork that project the regression channel forward to show the current expected path if everything remains fundamentally the same. The 5 and 10% pullbacks represent noise, and then a correction in a bull market where we are in the middle of the noise channel. But this looks very healthy for the market poised to go up. The test would be 142. The downside would be this resistance at support at 136, then 133, which would break it out of the regression channel. ETF2 summary, only Japan is on a cash position, so 9 out of the 10 regions of the world are healthy, so that's why we're 90% invested, 10% cash. You can see the weakest and the strongest. World market model, starting to see weakness now come into the U.S. Only the large caps are holding on. I would expect now to see the emerging markets start to play catch up because they've got more ground to make up. And you see the strength in Asia, Malaysia, and Singapore, which have been relatively strong all year, now moving into the white and the green. Asia less Japan, you see it's the strength is in Asia and not in Europe, although Europe has gotten better to be fair. So the U.S. is starting to lose its edge. And in the business sectors, it's still the defensive plays, although there's now strength coming back into energy and tech. It's still, for right now, staples, utilities, and healthcare. both in the U.S. and globally. Top 30 ETFs for your reference, same usual suspects. And the Dow 30 lens, it's all the XLP type companies. Walmart, Disney, Merck, Verizon, Pfizer, GE, Coke. At the bottom are still the producers, Hewlett Packard, Caterpillar, Cisco, Alcoa. Looking at the regression line crossover in the river, the spiders are still strong. IWM has started to recover, but you can see it's still stuck right at the Bollinger Band mean in the middle of the river, while SPY has already broken out and gone higher. That's the relative weakness of small caps at work. Treasuries rejected their high and are falling back into the river. That's healthy for stocks. Gold has still been inching higher. That has the room to run as a hedge if there's weakness in stocks. And the volatility study still within normal parameters on the short term and then the 5-year look back. Shifting to the daily. No signals in overreaction or channeling. You can see how volatility is pulled back to normal, just slightly starting to hook up, but still right smack in the middle of normal. ADX below 15 is weak, but the bulls are in charge, reversing the position from last week when the bears were in charge. 10-day max pain candidates, DuPont, Verizon, Microsoft, Boeing, Hewlett Packard. In the ETFs, it's VIX, natural gas, biotech, treasuries, and oil and gas exploration. Signals for channeling and overreaction on treasuries. Verizon is a triple screen. XLF and XLY are 551Ws. And then in the auto framer, the first 4 candidates are the best. VIX, Boeing, DuPont, Cliffs Natural Resources all test out better than 2 to 1. You can see very few signals. A number of dojis in the Dow. Nothing weak on the RSI2. And the top 5 max pain range compression candidates. Boeing, Hewlett Packard, Verizon, McDonald's, Procter & Gamble. In the ETF 30s, again, it's just treasuries on the channeling and overreaction. Only a couple dojis, real estate, Latin America, agriculture. Max pain range compression candidates, mostly commodities and alternate investments. Lots of frog quality. There's a 4.1 frog in XLY, for example. Regression line, you can see the breakout from previous high and the upward slope of the regression line. It's crossed back over its 10 period and getting stronger. And even the percent stretch relative to the 200, you can see it's slowly making gains. Looks like a Chinese serpent dance there, but it's getting higher highs and higher lows, and that's favorable. In the Z-score of the regression lines, the 90 is continuing to confirm. The 10 is broken out. The 30 is hooked higher. That's all very, very favorable. You can see price now actually starting to get less volatile in its wobbles around the upper Bollinger Band limit. And that's favorable as well. That's like jump-starting the market's heart after this little scary 10% pullback. The width of the channel, in terms of volatility, still relatively low end of normal. Z price getting ready to get better. Frog quality number for reference. Fail stat for reference. Signal to noise ratio for reference. Holding X day periods for reference. All the Z-scores are still relatively low, so there's a lot of room to run on just a normal range expansion. Mid caps and small caps have been decidedly weak. Starting to see a little bit of juice now, just from Friday, a one-day turnaround in IWM. And so it looks like the risk-on candidates have, right now, technology is better than the market and better than the smalls, although those smalls have more room to play catch-up. Watch for that. got much better. Emerging markets starting to surge too. I think we're starting to see some tentative risk on money coming into the more speculative regions. That's how I'm interpreting this stuff. Yeah, just more reference material. That's just a quick look at the market then for the weekend, August 4th. Having a good time out here in Raleigh with the frog traders. We had 30 traders, each taking 100 trades through the trading simulator based on real data, bar at a time. And we're having them compete against a mechanical rule set that has positive expectancy with simple rules. And 3/4 of the traders are doing better than the machine and getting better with each subsequent iteration. And then we're learning how to analyze that data set with statistics and look for areas of improving their trader discretion. They've made enormous strides already. It's been a very powerful experiential learning exercise. And I really can recommend this workshop for your trading improvements. It's been a pretty special 3 days. So, Ken Long from Tortoise Capital. Have a good weekend. Keep your powder dry and your risk measured. We'll see you in the chat room.